There's the legend. Matt's another great guy to have on board, and he's got, I think, Anthony with him today too from his team. What I like about Matt is, he's another guy that when we hire a client, he does a free review of their taxes and shows them, listen, you overpaid. And if you don't want to overpay anymore, guess what? We can help you fix that problem. So anybody that's going to show you where to save money, and it doesn't cost you money right out of the gate to do that, we're excited about people like him. And I get my tax advice from him. I think you should too. So I'm going to turn it over to Matt. There's a lot of questions I'm sure that are going to come up from this one, but we got you recorded and we got the Q&A, and we'll keep you rolling. So take it away, Matt.
Absolutely. Well, I got started like many of you. I was very entrepreneurial right in the early 2000s, started a coaching business. And it wasn't long till my coaching business was doing really, really well. And I wasn't really excited about it. In early 2000s, Wharton School of Business named me as Entrepreneurial Coach of the Year. Everybody thought, well, that'd be a great thing to just springboard off that and move on into some more coaching success. But what I was doing was I was bringing in specialists, guys like Larry, guys like tax people, and I was having them speak to my clients once a month so that I wasn't having to do all the meetings with all the clients and I could take a breath because I was only getting paid for the hours I was sitting in front of my clients. During that time, I was introduced to a guy that was doing something called tax tune-ups. And he started working with my clients and just got rave reviews. The thing I started noticing very quickly was he would come in and he would work with one of my clients, and immediately my client was introducing him to 5-10 different people, 5 to 10 different other businesses. And yet my clients weren't introducing me, and I was having good success with them. What was going on? And here's what I come to find out. Most business owners are very good on the offensive side of the game. You know what to do to grow your businesses. You're learning, you're working with professionals on marketing, and things are going really well for you. But what you don't think about is you don't think about to the end of the year paying those taxes, or you don't think about, how much you've paid this. I think it's amazing how many times Anthony and I will ask somebody, so how much you've already paid in quarterly estimates? Well, I don't know. And then when they start looking back at those estimates, they're shocked. And so we're able to go back and help them. So that happened early in the early 2000s. I made the switch to being a proactive tax consultant. And over the years, things went really, really well. But in 2015, 2016, one of the guys that I was working with, he had trained over 3,000 CPAs, and he actually sold his company to a publicly traded company. And then I was left to either sell my portion of the company to them or go out on my own. And what I did was I looked for who was the best out of those 3,000 people that had been trained by the organization that I had been a part of. And it didn't take any time at all until everybody pointed me to Anthony Amator. He's our chief tax strategist. He oversees each and every one of the tax strategy plans that go out of our office. He's got a large group of CPAs that he manages. And so I always tell people, if I could clone Anthony, I would have the #1 and #2 proactive tax strategist in the country. So he's on the call today, mainly for the portion today of the phone calls, but a lot of this information has come from other presentations that we have done. So you can go ahead and click forward there. Let's just talk about how most businesses go about paying their taxes. You make your money, you maximize your deductions, and you pay your taxes. This goes on year after year after year. In 2017, one of the major tax changes in our lifetime took place. And here's what we see. On about 90% of the returns that we review, your current CPA is not taking advantage of things that you could have been taking advantage of since 2017 Tax Cut and Job Act. The bad news, and we're going to get this later into my presentation, it's very likely that all of that is going to go away as soon as the new administration takes place here in this month. And so you're going to lose some of those opportunities. And here's the reason why that happens. Let's be honest. You probably have a great CPA. They're good at telling you, here's the numbers, here's what you're going to owe in taxes, here's some of the things we can do. And we'll talk about those in a little bit as well. But what interests me, even though we've got great CPAs, you've got great trusted advisors, In 2018, Forbes did a study. Now, this was a study where they went out to business owners and they actually pulled their tax returns, looked at them, and had people like Tony look at them. And here's what they found. The Forbes did a study to find a number of small businesses who were overpaying in taxes. 93% of businesses are overpaying in taxes. I can tell you some of the companies that are not there. Amazon is not one of them because they're using it. They're taking advantage of the IRS code. Most small businesses are not taking advantages of the opportunity to legally avoid paying taxes. Now you say, I'm not in that 93%. And if that's the case, that's great. I love seeing the transition from somebody working with me and telling me, well, I love my CPA. They're doing great for me. Everything's going well. I don't think that I'm paying a lot of taxes. They're getting me down to where I don't need to pay as much taxes. And then after we go through our assessment and they start talking with Tony, they start to ask him, okay, now tell me how to, I play golf with my CPA. How do I transition away from this relationship? And Tony says, send him a bottle of wine, go play golf with them, but get your tax strategies in place before you do your taxes. Don't wait until after you made the money and then figure out how to avoid the taxes. It just doesn't work that way. We can go ahead and click to the next slide. And the question is asked, well, wait a second. Why? Oh, I'm sorry. I'm a slide ahead there, Vernon. Go back one slide. So why do you overpay? Here's what happens. You own the business, so somebody in your office is keeping the records, either on QuickBooks, Peachtree, or one of the other ones. From time to time, you get different records to your CPA, and then your CPA tells you how much you owe, and then you pay. There's never really any dialogue or questions. I always ask people, when was the last time your CPA comes to you and says, hey, I've got an idea that's going to save you money? I get two responses from that. Usually one is a chuckle, or number two, it's disheartening. They say, I never get any information from my CPA. Normally what happens is I get information from another business owner. Then I go down to my CPA towards the end of the year and say, hey, I've got other friends that are doing this with their vehicles, or they did this thing called component depreciation on their building. Can I do that? And the CPA simply responds, yeah, that sounds like a good idea. So the only proactive person in most CPA relationship is the business owner. So you want to keep that in mind. If you're working with somebody that is not coming to you with ideas, or at least wanting to know what's going on with your business, your family, when you're thinking about selling or buying business property or assets, those are the type of things that are very crucial for somebody that's being proactive in the planning. And I always like to tell people that the Internal Revenue Code is broken up into two separate parts. One is like a red light. It tells you to stop and pay taxes. And that's really what I would say. Most CPAs that we recognize, that most of them are what I would call a red light CPA. They're basically looking for times that they can help you avoid getting penalties and interest by paying taxes at the right time. They're putting the right numbers in the right boxes at the right time. And that's really true to what you're paying them to do. You're paying them to be an accountant. They're taking account of the money that you're spending, the money that you're making, and they're making an account of it to prepare for your taxes. However, that's only 25% of the tax code. 75% of the tax code is how to legally avoid paying taxes. Theodore Roosevelt shared in a statement. He said, the majority of the tax code is there so that American citizens can avoid paying taxes. And yet that's the least part of the tax code that's typically used. Most CPAs, and it's not their fault, they don't have training on proactive tax accounting, because what they're focused on is training for that CPA test, that accounting portion, right numbers, right boxes, right time. Not based on your current situation and the changes that's coming with the Biden administration. You need to be making these three things a priority to be prepared, because this is going to change very drastically. And if you own a business and are thinking about passing it on to your children, or you own property and you're thinking about passing on to children or appreciated assets, this is a huge time to be thinking about how you're going to pass those on to your children, because that's going to drastically change. So which section of the current Internal Revenue Code does your CPA talk about the most? And then ask yourself, where do you want to focus? Do you want to focus on right numbers and right boxes at the right time? That's that's 25% of the taxes. 75% of what you need to be doing needs to be proactive. You need to be taking advantage of those 75% of the pages that help you to legally avoid. Now, a lot of times when we talk about taxes, people get the idea that taxes are just out of control. In fact, as you look at this chart here, going all the way back to the early 1900s, you're going to see that our tax brackets are at an all-time low, and that's an it's been that way since the early 1990s. However, there's two things that are taking place in our economy today, and I want you to go ahead and click to the next slide, Vern. One more slide.
You want the one with the graph or the next one?
The next one. It's also a graph. So here's what's taking place today. So since COVID, we've seen a huge increase in the deficit. Revenues are shrinking for the government. Deficit is increasing. We're at a place today where the national debt is now $27 trillion. The interest that we pay on the federal debt now is the fastest growing part of our entire United States budget. In fact, we spend nearly $1 billion per day just on interest. So this is a problem that is quickly spiraling out of control. And here's what's happening. Today, the GDP and the national debt is right around 75%. They estimate in the next 8 to 10 years that our national debt will be 120% of our GDP. That's what the United States produces in domestic product. Now, here's what happens when that happens. Two things they can do. There's only two ways that the economy can work under those situations. Number one, the government has to raise taxes. So it didn't matter if Trump got into office or Biden got into office. One way or another, they had to figure out, how are we going to start making these huge astronomical payments? And the other thing that is going to happen is going to be inflation. So the problem with that is as your taxes go up and your income therefore goes down, now the dollar that you have is not worth as much as it was in the past. And so what I've done is I've taken a little bit of time, done a little bit of math here. And Vernon, you can go to the next slide. If you're a business owner, you and your family own this business, and let's say it does $1.2 million a year. In our current scenario, you're going to see here, just follow that first column all the way down to the bottom. If you're taking advantage of just some of the simple things that you're doing, and actually line number 2, the QBI, we find that there's a lot of business owners that aren't taking advantage of that all. That's what came available to you in the 2017 Tax Cut and Job Act. But most accountants didn't really understand it, so they avoided it for a couple years. Most of the tax software that does your taxes typically in a matter of about 15 to 20 minutes wasn't ready for that type of major change. So it took them some time to get up to speed. But current situation, got a business, 1.2 million, you and maybe 2 or 3 of your children are running it. Down at the bottom, you're looking at roughly about $280,000 in current taxes. Now, I didn't put the name of the administration there in column 2, but based on everything we all know, based on everything we've seen of what the new administration tax code is going to be like, and a lot of this will still depend on some of the things that are taking place right now in Georgia, but they have to make changes to the taxes. And this scenario only puts in there, instead of a 37% highest tax bracket, we only ratchet this up to 39.6. So we didn't go crazy on making a 50% tax bracket. But the same thing happening in 2021, and this is why you need to start being proactive now. Same income, you're going to lose the QBI, everything is going to go down, your self-employment deduction is going to go up. But here's what happens. Let's look down here at the very end, taxable income line. In today's scenario, you have taxable income of $844,000. In 2021, not making any more money, you're going to have taxable income of well over $1 million. And here's what happens. The difference is $280,000 paid in taxes under current scenario, just by some of the changes that we know are going to take place early in 2021 and thereafter over the next 4 to 6 years. You're looking at 458 on the exact same income. $178,000 more in taxes next year if you made the exact same amount. Now, here's what this means. You might say, well, Matt, I don't have a business that does 1.2 million. These numbers are going to play the same way for you. It's just going to be the percentages. So just by looking at the total increase in income and payroll taxes is $178,000 in this scenario. But what that really turns to put the play for you as a business owner, overall, you could be looking at anywhere from a 40 to 64% tax increase. Now that's what hurts. That's what happens when, if you continue doing the same thing you did this year, this is what's going to happen. You're going to pay between 40 and 64% more in taxes in 2021. After tax income will go down significantly, and that income is a 22% decrease just by the way that they're going to handle your loss of the QBI and the way that they're going to do some of the changes on the payroll taxes. So here's what happens. You're going to pay more taxes. You're going to make less money. And we know that inflation is coming just around the corner because it can't keep up with our GDP to a national debt. So all of this is going to happen whether you're making $125,000 in your business or $1.2 million in your business. It's time to start tax planning. But let's ask this question. I told you earlier we're going to come back to this. I've got a father-in-law that for years has done very well investments in a couple of rental properties. And his plan to pass these on has always been to put them in a situation so they get what's called step-up basis. So, let's say that he bought Amazon early on for $200. And today it's $3,000. If he passes that on to a grandchild at his death, they actually get the step up basis. They don't have to pay the capital gains from a $200 stock moving to $3,000. Same thing in your real estate. Some of his real estate properties was going to some of his grandchildren. Some of this real estate he bought for $25,000, and today it's worth $180,000. They're actually going to have to pay capital gains on the difference. That's one of the things that we know is coming. That's one thing that both administrations and both parties were looking at is how do we avoid this huge transfer of wealth and people taking advantage of step-up basis. And that's why I work with people like Tony, because Tony has been working and preparing for scenarios like this for the past several years. Because again, when you're proactive, you're looking out the front window of your car, you can see things coming. Most CPAs are sitting there, they're looking in the rear view mirror, and they're looking at the money that you made last year and how much you owe. So go ahead and click to the next slide. So typical tax planning. These are the things that we don't do, okay? We don't tell you to buy more and depreciate it. I went to visit a large contractor in my area. When I say large, he basically, when you see somebody getting gravel, it's one of his dump trucks. He's got several drivers, several dump trucks, huge, what's it called, mulch business. So I pulled into his parking lot one day and I seen about 14 different skid steers, all pristine, all sitting there looking to be within the last couple of years purchased. And so I go in, I sit down with him and his wife and I say, wow, this is an amazing property. You keep it really well. I know you guys do a great job of delivering, all these aggregates to landscapers. And I appreciate, the delivery that you made to me this past spring. I never really knew that you had that many people working here. And his wife started laughing and she said, well, I work in the office. Wayne does the deliveries, and then he has a couple guys that has their CDLs that'll drive, and we pay them. But other than that, it's just my daughter and my son. My son is because of his rehabilitation, can't operate heavy equipment. And my daughter doesn't even drive a car, much less any piece of equipment. And I said, I got to ask you a question. I drove past about 14 skid steers lined up out there. They all look like they've been bought in the last couple of years. He goes, yeah, Matt, with the Amazon facility going in, I'm supplying them with all of the aggregate for um, the roadways there. And so he said, for the last couple of years, they've been buying and stockpiling. My business has done extremely well. And so what my accountant has done for me to avoid having these great years is I buy more equipment. And so I said, Wayne, I'm sitting here thinking about this. Your wife is not driving a skid steer. You drive a skid steer. Sometimes your other guys come in and use a skid steer. Your son's not allowed to drive a skid steer, and your daughter wouldn't know how to start one. You're basically just buying these assets to depreciate. He said, yep. I said, what happens when you go to get rid of those assets, or what happens when you go to sell? Because that's the reason we're meeting. He said, I don't know. My accountant's never really talked about that. So we talked about depreciation recapture, and he was shocked. So for the last couple of years, he has bought, I think it was 11 new skid steers over the last 2 years, thinking that that was a way for him to avoid taxes. And his accountant has been depreciating these on a very accelerated depreciation process. Now, when he goes to look to sell them, he's going to have to get the depreciation recapture, and he's going to end up paying those taxes anyways. So that's not a great plan. The second thing that some of you may be involved in is putting money in qualified plans, like an IRA or a 401k, things like that. As a business owner, that's not really your best approach. Let's think about it. You know, if you're doing a standard 401k plan, you're putting almost $19,000 a year into that. What is $19,000 a year going to grow to in the next 10 years that is going to help you live the lifestyle that you've become accustomed to? And here's the next question. I think this is a great travesty that many of our middle Americans have bought into. When you think about qualified funds, here's what's happening. Your CPA is allowing you, the IRS is allowing you to put money into future retirement. But they're saying, I don't need you to pay on that $1 now that you put it in there. We're going to let you not pay on that income this year. So you're basically going to defer it. Folks, if you remember the chart that I showed you just a minute ago, we're in the lowest taxable brackets that this country has seen and since the early 1900s. Why would you not want to pay taxes on the dollar today? Then instead you avoid them to pay taxes on a time in the future that you don't even know what the taxable rate is going to be. And it's all going to come out of those qualified funds as ordinary income. Anthony, our tax strategist that's here on this call, he has different ways of you be able to put money into retirement accounts that also allow you the opportunity to not have to wait to 59 and a half to get access to them, but it's much more tax efficient for you. And it's avoiding taxes today and avoiding taxes in the future. But qualified plans is just something that is just something that everybody knows about. And so that's what people move to try and to avoid taxes today. But remember, there's three things that are unavoidable, or three things that are certain. Of course, death. You put two socks in the washing machine, only one's going to come out. And the third one is going to be taxes. And the thing we know for sure is taxes are going to go up. So there's ways that you can avoid paying taxes today, avoid paying taxes in the future, and it's not by putting it into qualified funds. I love this one. I just got this answer when I asked an individual that owns a business. He says, my accountant told me that I've made good money this year, and so it's just my patriotic duty to pay taxes. You made it, now you pay it. And I asked him this question. I said, I think it's great that you want to be honest. I'm not going to do anything that's dishonest. When it comes to taxes, I believe I'm going to be honest, but I don't want to be generous, because your income tax is actually voluntary. And when I say voluntary, because of the way that you can set up your businesses as an entrepreneur, you can control the amount that hits your actual 1040. That doesn't mean that you spend less or your lifestyle diminishes, but there's ways that you can have money flow that's in a much more tax efficient way than, say, all this money hitting your 1040. So the adage of you made it, now you pay it, Again, 75% of the tax code is there so you can legally avoid paying it. Now, to get there, it's not always cheap, and I always like to make this announcement during a presentation. What we do, it's not cheap. I recently was working with a franchise owner that had a very good year this year. He um, has coffee shops that chain that of course, coffee sales have went up quite a bit during COVID. People just want to get out of the house. They swing by their local coffee shop, pick it up, and his 5 stores have just done amazingly well this year. And so when we showed him that we were going to save him $124,000, but to get there, it's going to be $124,000 just this year. And moving forward into next year, there was going to be additional $180,000 in 2021. He said, Matt, that's all great, but the cost is too great. And I think the fee there was $74,000. So he said, I got to ask you a question. I sell coffee for a living. I'm just a business owner that's been very fortunate this year, and I've done very, very well. Here's my question to you. Would you buy a $10 cup of coffee? And I said, oh, that depends, Dinesh. I said, I would buy tons of $10 cups of coffee if there was a $50 bill taped to the bottom of it. So that's what a tax plan does for you. It is known, guaranteed money back in your pocket. Don't make any more money. That's one we hear all the time. Third quarter meetings, you're sitting down with your accountant. Well, you really need to be careful. You really don't want to make any more money this year. I don't know any entrepreneur that likes to move that direction. So let's go ahead and move to the next slide. And I'm about finished here. What does Tax Strategy Pro do? We work on the 75% of the tax code in the Internal Revenue Code that helps you take and combine time and sequencing the different tax code to give you the most leveraged approach to paying your taxes. You can go ahead and move to the next slide. Many times when we do this, we get the question, well, hey, is this legal? Are you going to create an audit potential for me? And the truth is, because we use the tax code to do it, we actually reduce your audit potential. We're not using black hat type magic. We're simply using legal, ethical, and moral ways to avoid the tax code, to avoid paying taxes by using the tax code. Recently, we did a huge seminar. I was back in 2014, where 30 different people came into the back row, and I was introduced to a special agent from the IRS. All these people that she brought in that day was, she goes, Matt, I appreciate you allowing us to come today. We're here today because we have reduced forces on the IRS when it comes to auditing. I don't want my agents auditing people that are using the types of strategies that you guys are employing, because you're using the tax code the way it was meant to be. And we need to be auditing people that are avoiding taxes illegally, not legally. So go ahead and move to the next slide. Finally, what does Tax Strategy Pro bring to the table? We have a nationwide nationwide network of tax strategy professionals. Anthony is our chief tax strategist, so he makes sure that everybody, every tax reduction plan that goes out of our office, he oversees it. Like Vernon said, we do offer to devoted enterprises a no cost, no obligation assessment. It's very, very simple. 45-minute phone call so we can make sure that we have your facts, circumstances aligned with your goals and objectives. And then we just review and do a deep dive into your last couple of years business and personal tax returns. We have guaranteed results, meaning that once we do that, if we find out there's savings, we will put it in writing how much money that we can guarantee that we will save you. Along with that is the audit protection. You don't pay any more for that. That year that we do the tax plan, if you are one of the randomly 3% audited individuals, we will go to bat for you at no cost to you, because we know that we can defend what we put into play. And finally, different from many of our competitors, we focus on education. It is a done with you approach. We'll do all the heavy lifting, but we want you to be educated, because as things take place, you need to be more educated as the taxes, the tax landscape is going to continue to change significantly because of the national debt and what they need to do to get that under control. So you need to be educated, so you're asking the right questions. And Bern, that's pretty much it for me today. Finally, the way to move forward is just call Devoted Enterprises, and they can put you in touch with us. They've got access to our calendar. They schedule the free analysis for you, and then basically the next step is to start saving money. And we'll even go back for free and find out what we can find in amending your tax returns by going back. So money you've already paid, we can claw that back from the IRS. You
That's
win, we win.
fantastic.
IRS loses.
Yeah, that's fantastic, man. We're actually doing that with one of our clients right now. You're going back in history and getting them some more money. So that's the way it should be. And, you know, if you didn't learn something about taxes on this presentation, whew, you probably were not paying attention. And this is exactly why, you know, again, that I picked us three to speak, because between Larry and I know that we can help your business make more money. He's going to help it grow. I'm going to help you save more money within your business, be more productive, increase profitability, productivity. And then Matt's going to help you, you know, pay less taxes. So we thank you, Matt. We're going to move into